Okay, welcome back, all you beautiful and sexy human beings, guys. We've covered some of the history in terms of what is the Forex market, where did money come from, where is it busy going. I hope you guys found that insightful and you've learned something from that. It's now time to move on into the different currency and currency pairs setup that we're going to be finding and the items that we're obviously going to be trading together in the coming days and coming weeks. Now, this is super important. Now, if you're starting out, this is going to mean everything to you. If you're an existing trader and you've got a bit of knowledge, you've got a bit of experience, this will be just as helpful. Oftentimes, I advise people that have just jumped into the markets, they jump straight into NASDAQ or straight into VIX, and they often find and they're struggling to be profitable and consistent. I often tell them to take a step back, go back to the basics, build up their strategy, build up their confidence within this market space, and then progress and move on to some of the more volatile assets and commodities that are out there. So let's jump straight into it. We're going to be having a look at currencies. So let's just get right into it. Beautiful. Okay. Now, let's have a talk about currencies or currency in its singular form so that we can fully understand what they are, how do we classify them, and how do we eventually pair them together. So we're going to be starting off with what I call the eight major currencies before we even start looking at pairing any of these up. So let's get started. The first one is the United States dollar, right? We can see the symbol is USD. The full currency name is the United States dollar. And we can see it has a market share as of 2010. This data is accurate of 44.5%. This may have changed, but ultimately they've stayed kind of the same since the last survey was done. We can also see the nickname is sometimes referred to as the buck or the greenback. Now, the important thing about the symbol, right, is that USD is a derivative of the territory that it comes from and then the currency type that it is. So US is United States, that's the territory, and D is for the dollar. Okay. Let's have a look at the next one. We see the euro, right? EUR, and that's the Eurozone, and the currency is the euro. That has an 18.5% market share, and its nickname is quite simply put the euro, right? The euro obviously represents a lot of the European Union. That is a union that has all sort of been amalgamated under this single currency. Then we have the Japanese yen. Symbol is JPY. That has a 10% market share, and its nickname is quite simply the Jap. We have Great British Pound, symbol is GBP. We then have a 8.5% market share, and its nickname is quite simply the sterling. We then have the Swiss franc with a 3% market share, nicknamed Swissy. We then have the Australian dollar AUD with a 3% market share, and that is Aussie. We then have the Canadian dollar at 2% with the nickname Loonie. Then we finally have the Kiwis and the guys in New Zealand, the New Zealand dollar, and that has a 0.8% market share being the Kiwi. Now, what makes a major currency? These are the currencies that are the most in circulation. They're the most liquid. There's the most supply of them. And quite frankly, most of the world's transactions happen in these 8 major currencies. We can see that the United States dollar has an overwhelming market share of almost half of the world's FX transactions happen in the United States dollar. Now, why do we classify them as major, minor, so on and so forth, right? Ultimately, this means that when we have something that is greatly in circulation and the supply is very, very high, and there's also a equal or high demand, it means that the transaction costs of these currencies, transaction costs are low, not the value of. In most of these cases, these are some of the most valuable currencies in the world, right? But the cost to transact with them, to trade or exchange, these transaction costs are low. All right, now 8 major currencies is obviously a ton of currencies, as many countries as there are in the world. With the exclusion of these different unions, there are just as many currencies. So the reason we talk about these and the reason why we have a little bit of a focus on them is just because of their efficiency in their cost to trade. Now imagine this: if you're starting a new business, you want to obviously be as efficient as possible. As you diversify and if you're a car dealership, you'll start with, common cars that there's a good supply of, there's a good demand, and you'll start selling your VWs and your Polos and your Toyota Corollas. And as a car dealership, you'll start doing business in this way to keep your efficiencies as high as possible, your costs as low as possible, and to obviously make a profit and make a return. It's very, very simple and very similar in the Forex and financial markets. When you're starting out, and specifically if you started just trading your NASDAQs and your VIXs and all your synthetic type instruments, you often want to come back and realign. Specifically, if you have not been profitable and you've obviously lost some money, you want to come back to the basics. These are the basics. Now, what I would recommend if you're brand new to this or you're just starting out, these are the currencies you want to remember. What I would suggest is write them down, write down the symbols, get to know the symbols, because we generally don't say the full names. We usually would say United States dollar, euro, JPY, so on and so forth. So write down these 8, memorize them, and give yourself a test in terms of, can you remember all of them? If you can, and if you're just starting and you've remembered all of them, comment down below if this is a test that you've passed, and if you were able to recite not only the symbols but understand what the currency is. Bonus points if you're able to remember the nicknames as well. You'll see in a lot of forums, and when we read around a lot of financial news sites, will sometimes just say the sterling is up 2.5% today based on yesterday's trading news. So you would then need to incorporate the nickname. So give yourself that test, comment down below, let me know how you did. Now, when we talk about trading, as we talked about the word foreign and the word exchange, the word exchange meant that you need at least 2 parties, right, to either buy or sell a good or service between one another. In the context of foreign markets or foreign exchange, we're talking about money and we're talking about currencies. So obviously we need 2 currencies to value or buy or sell against. And this is where we move on to where we start talking about currency pairs. So let's have a look. First, we're going to start with the major currency pairs. So these are all the major currencies listed against each other, and what you'll find is there's a common denominator amongst all of these. So first we have Euro USD, followed up by United States dollar, Japanese yen. Then we have Great British Pound, United States dollar. Then we have United States dollar, Swiss franc. United States dollar, Canadian dollar. We then have Australian dollar, United States dollar. Then we have NZD USD, which is New Zealand dollar, United States dollar. Now, what is the common denominator you see amongst these major currency pairs? I'll give you a second. You can drop it in the comments. 2 seconds, I'll let the good vibes pick up. And let me know how you guys are finding the music. If you guys are loving these tracks or what. I'm loving these tracks. Keeps me pumped throughout all the sessions. So the answer should be United States dollar. United States dollar is the common denominator here. And when we talk about major currency pairs, we will always find the United States dollar involved in these majors because, like I said, it almost represents half of the total market transactions. When the United States dollar is involved with another major currency pair, this creates what we call the 7 major currency pairs. Now, the order in which they are listed is greatly important. When we look at the Euro USD as an example, we can see that the Euro is listed first as the first currency symbol, and then we see the United States dollar. The order in which they listed is greatly important, right? You'll very rarely ever see something like Euro USD Euro, right? Some banks do have that listed in that particular manner or way, but ultimately this will be the set standard for how these are listed. Now, we call this first currency symbol the base currency. The second one we call the quote currency. In whatever order they're in, that's the order which we call them. So if we have a look at United States dollar, Japanese yen, United States dollar is the base currency, Japanese yen is the quote. So when we talk about this from a price perspective, we are saying 1 United States dollars equals how many in Japanese yen. So we're looking at the exchange rate. So $1 can buy how many Japanese yen. Okay, and we're going to get more into that when we get into the charting. I'll explain all that in great detail. And we'll obviously expand on that, and it'll be quite a great revelation for you. But it's important we understand the base currency and the quote currency. Base is always equal to 1. The quote is a question mark of the relationship in those two. So that is hugely important. Now, when we talk about the cost of transaction, right? Because now we're grouping them in these different classes. The cost in transaction is the difference between the buying and the selling price of a particular currency. Now we call that the spread, and we are going to get into that in great detail later on as we move into the series. As I talk to you guys about spreads, we can obviously unpack that quite a bit, and you need to be able to calculate pips in order to understand the value of a spread. And again, we're going to get into that in great detail moving forward. But for this purpose, all we need to know is these classes differ the different transaction costs in order to trade. So the major currency pairs are the cheapest currency pairs you can physically trade. And like I alluded to earlier, if you're starting out, this is where I would want you to focus. If you're an existing trader struggling with profitability and consistency, I always advise, I get many traders that come to me a year or two of trading, self-taught, or they paid these Instagram gurus money to be able to learn how to trade. They struggle to find their feet, they're failing to be consistent or profitable. I generally, ask them to take a step back, go back to the basics, perfect on the lowest cost items like major currency pairs, get strategy, get your mindset right, get all these processes right. Obviously, towards the end on the quantum growth market strategy, I'm going to be expanding on all that. You're going to get a step-by-step strategy and perfect that here first before we move on to your more volatile instrument classes. Now bear in mind, we're focusing on Forex for the framework for the syllabus, but we trade all kinds of instruments. We trade crypto, we trade different indices, we trade commodities. The application skills that you're going to learn here can be applied throughout almost all classes. There are certain classes that require different techniques and different knowledge, such as stocks and such as futures. This will require different types of analysis, but ultimately the charting techniques and the understanding of price remains the same. And we will cover that in obviously future educational series. So we have our major currency pairs. Let's move on to the next currency class and let's have a look at what they are. So up next we have what's called the minor currency pairs. Now these minors are a combination of all majors, right, listed together with the exclusion of the United States dollar. All right. Now, these all have the euro as the common denominator. The euro at this particular point is the base currency, but there are many different minor currency combinations. These are the 6 most widely accepted, the euro being the second most traded currency or in circulation or liquidity from a liquidity standpoint in the world. These are the 6 most widely accepted, but there are many more, right? Any combination of major currency combination would form the base of that. And just as I've asked you to obviously memorize the major currencies, I would also recommend that you memorize the major currency pairs, the ones just before this. The minors, not too much. You're going to find them out there. So again, if we go back to what I've said that the major currencies are the cheapest, major currency pairs are the cheapest to transact with. What does that mean, the minors? Are the minors super expensive? No, not necessarily, because they're still major currencies. There's still a massive supply of them within the market. It just means they're not as cost effective from a transaction cost perspective in comparison to some of the major currencies, right? Still greatly effective, still great to trade and fairly cheap to trade, just not as cheap. Okay. Up next, we're going to move into our next class, and this is referred to as our exotic currency pairs. So let's have a look here. So exotic currency pairs will be all of the lower supply, lower demand currencies out there in the world. Obviously, there's many different countries in the world that each have their own currency. So there are lots of currencies out there in the world. Now, these will be currencies that are, again, like I said, just less in supply and probably less in demand too. Examples of this would be something like United States dollar, South African rand, United States dollar, Mexican peso, and the United States dollar, Danish krone. Now, this all really comes down to supply and demand at the end of the day. Now, if we have an increased supply, right, and an increased demand, a higher supply and higher demand ultimately results in a cheaper transaction cost because there's more buyers and sellers in that particular market. Example, the United States dollar, there's more people willing to buy and sell it, making the buying and selling rates more competitive, driving the transaction cost down. When we look at something like the Mexican peso or the South African rand, there's less of a currency supply in the market, and ultimately there's less buyers and sellers willing to buy and sell that particular asset or commodity, and so the cost of it essentially from a transactional standpoint is higher. Okay. Now, looking at this from a consolidated view in terms of market cap, we can see the following, right? And just a recap in terms of the different classes. Majors are major currencies listed against the United States dollar. Minors or cross currency pairs are major currencies listed against each other, excluding the United States dollar. And exotic currency pairs are just less traded currencies, in most cases listed against the United States dollar. It's not a prerequisite, it's just a probability, a high probability. Now, if we look at that market cap in terms of the pairs, we can see that Euro USD is the most traded currency pair in the world, representing almost a quarter of all transactions happen within the Euro USD combination. Okay, USD JPY coming in at 14%, GBP USD, AUD USD, USD CAD, USD CHF, Euro JPY, Euro GBP, and then other, which is the darker blue color, this one over here. This represents all other currency pair combinations in the world, right, are equal to just the Euro USD. That means all the countries, all their currency combinations, and there can be thousands of currency combinations, all of their trading volume represents also only a quarter of the trading volume of these over here. Now, bonus question for those of you who want to win some brownie points for whatever that means, right? If we have a look here, we can see Euro USD, that's a major. USD JPY, that's a major. GBP USD, major. Australian USD, major. USD CAD, major. USD CHF, major. Followed by two minors, Euro JPY, Euro GBP. There's one major that's missing, and bonus points for whoever in the comments picks it up. Let me know in the comments which major currency is not included here in the total summary of market cap of currencies. Whoever picks it up, you're welcome to pause the video or drop in their comments. The first couple comments, I don't know, we'll do something special. I'll do a one-on-one with you, a live session. We'll have some time together. If you can see you're not the first to comment anyway, and I can see you guys are putting the effort and you're enjoying the content and getting involved. All right, beautiful. So again, we can see Euro USD, the most by market share. So Euro USD is undoubtedly the cheapest currency pair that you can trade. So if you're starting out and you want a really cost-effective currency that you can obviously get involved with and trade, Euro USD no doubt is going to offer you the best value for money in terms of that trade transactional wise. Again, this is called the spread. In order to understand the spread, we have to understand pips, and I'm going to get into that in great detail as we proceed. But generally speaking, these are the foundation blocks of where you need to start on majors, then have a little bit of a focus on minors. If you live in a country that has what is called an exotic currency like South African Rand, pay attention to them, but just remember the transactional cost is very high. You'll pay a very high spread to initiate a trade there out the gates. It's obviously not ideal. If you've got limited trading experience and a limited account size, you generally want to steer clear of some of those currencies and some of those setups over there. All right, up next, we're going to be jumping into market players. So let's just jump right in and have a look at the different market players and participants that are involved. So let's get moving. So right here, guys, we're obviously going to be discussing the different participants in this market space, and where do you fit in the greater picture, and where do you fit in the scale of things. So let's just jump right in and let's get started. So when we look at the markets, and this is obviously sometimes a lot of traders think that they are the ones moving the markets, that they are the ones in control, that they are the ones pushing all the buttons. The truth and the reality is that they're not, right? As traders, we form a very small portion and part of the markets. Now, right at the top of the markets, in terms of the hierarchy, we have what's called banks, liquidity providers, and governments. Now, banks, when we talk about large banks, we refer to them as super banks. And what you must understand is the markets, the FX market is not a centralized thing, right? You can't go to the FX market and physically buy something, right? It is to some extent decentralized in the sense that the market is housed through the different banks, and each bank's transaction becomes a Forex transaction in that. Now, liquidity providers are essentially what we refer to as LPs, and they provide the liquidity for some of these transactions, specifically to financial institutions or institutional money, and they represent also a large portion of the market. And ultimately, we obviously have governments that their decisions, their flows of money essentially determine the direction of the markets. Now, if we look at this from a top-down view, it's going to look something a little bit like this. We then have hedge funds and large commercial companies, and then right at the bottom, we have you, or we have us, right? Right at the bottom of this food chain, this is where we have retail traders. Now, don't let anybody tell you that they're a professional trader unless they are a PT working for a bank or a hedge fund under license to manage certain amounts of money. If you're involved in Forex trading, assets, commodities, whatever the case may be, as I am, we are all retail traders. So when people come online and say, hey, they're professional traders, this, that, they're not. They're just retail traders trying to butter you up. But ultimately, what we need to understand is we sit right at the bottom of this particular market. We don't move the markets, we don't influence the markets. We're essentially observing where markets are going, and in most cases trying to understand and predict what super banks, liquidity providers and governments are attempting to do, and essentially following them in that distance, right? There's a saying that goes, the trend is your friend. Well, who sets that trend, right? The trend is set by or at least initiated by governments, liquidity providers, and super banks. Ultimately, thereafter, there's influence from hedge funds and large commercial companies, and we are ultimately on the tail end of that, and we are following that process. Now, to expand on this a little bit further, right, it's important again to understand that these entities control the markets and we're merely participating in what they're already doing. So these are the market players laid out in terms of the major market players, right? So super banks, examples of this would be banks like Citi, JP Morgan, UBS, Barclays, Deutsche Bank, HSBC. And so these are essentially massive entities, intercontinental entities that sit on most of the continents, and transactions can happen between banks across different territories. Right, and this is where they move large amounts of money and also liquidity. In most cases, these banks will also be liquidity providers, so they will provide the liquid cash in order to facilitate transactions. Liquidity from a financial standpoint, or just liquidity from a name perspective. You talk about liquid. The properties of liquid is to move and to flow. Liquidity in a financial perspective is the movement and the flow of money. Liquidity providers provide that movement and flow of money. Just to break it down and make it a bit simpler for you. For most future cases, we're going to refer to them as LPs. So the shorter name for that is liquidity provider, LP. All right. So super banks are the first and foremost guys. Large commercial companies. Right. Example. If Apple is purchasing parts from Japan in terms of some of their screens or batteries or technology, when they purchase these devices, when they purchase these things, they're converting United States dollars into yen. Again, they got to pass this through the bank, but ultimately large commercial companies can also have an influence on the stability or the movement of a market. Example, if Apple announces that it's moving all of its production of all of its components and parts from Asia back into America, right? What will that do to the Asian market? What will that do to the dollar market? It won't crumble or crush any of these markets, but it will have an effect. We could see the Asian markets take a slight dip, even 0.5% or whatever the case may be, but we could also see the United States dollar strengthen. So it's not that they have the ability to topple these markets, but they do have a big influence, right? So when it comes to orders, when it comes to just policies and regulations, they have a big influence on how certain markets move from a structural and strength perspective. Governments and central banks, this one is obviously very, very simple. Governments and central banks often hedge their currency against other currencies. So, for example, South African Rand might hedge in United States dollars. They might buy up a whole bunch of United States dollars so that if the Rand decreases, the United States dollar rises, and the profit made from the dollar rising will offset the negative of the Rand falling. This is what we call hedging, right? And this happens very, very often, but at the same time, governments, central banks, often they set the policies to control the supply and demand of currencies, as we've obviously said earlier on. We were talking about the history of money. We will get deeper into this when we get into the fundamentals of what those instruments are and what to look out for, and I can show you how to measure them and look out for them, but they have a big impact on the markets. The final group in terms of the market players are massive or large speculators, right? And this is essentially private equity or private funds that speculate against the markets, right? And they can have a profound effect if, they have a position or they have an opinion or they have a thought about where markets are going. And we've seen this very, very often, right? We've seen someone like Elon Musk will, in more recent times be classified as a speculator, right? In the issue of Bitcoin or Dogecoin, he's been very open about his opinion and saying, hey, this is great, this is not great. And essentially, he's caused the rise and fall of a particular currency. So he falls under a speculator's perspective in terms of a market player. He might not be physically involved in trading that particular item, but he has a place in the market where his influence and power can move and change currencies and things like that. The speculators are some of the hardest ones to potentially monitor. The others we can monitor with fairly good effectiveness. We can monitor commercial companies, governments, and banks in terms of their policies because they announce it and they have schedules, where speculators can just at any time jump out there and say whatever it is that they've got to say, and makes it a little bit harder. So now that you understand a little bit about who is playing in the markets, we have to be aware of their presence, but ultimately we are merely just monitoring and listening to what is being said to gain a bigger perspective. And as I obviously said a little bit earlier, I am a price action trader, so we rely on price and the movement of charts to dictate what it is and give us foresight of what it is we're doing. We merely take into account what these guys are doing and saying, so that it adds to our strategy. So in some cases it supports our directions, and in some cases it doesn't, but I'll show you some really amazing things as we get more into that. A lot of the times the things that these guys are saying, they're saying with the intention of influencing a population or traders' perspective on a particular item, and a lot of the times it does the opposite thereof. So it becomes extremely helpful to obviously be aware of them and also monitor. And we'll obviously get into that in a lot more detail. Okay, welcome back all of you beautiful human beings. We've covered a ton of things already. We still have so much more that we're still going to be covering. Now, if you're feeling a little bit overwhelmed, that is 100% okay. It has been designed in this particular way to challenge you and really push the amount of information that you can store and go through. I'd love to know in your comments, right, first and foremost, is there anything you found to be a revelation in the past couple videos? Because I can trust this next video is going to be a massive one. This video is going to help settle you down and get you a lot more comfortable with what is busy happening. If you feel like it's all too much, this video is going to really help you to visualize and set into your mind what a Forex transaction is. And it's probably one of my favorite teachings, for the reason being that I see so many people come back and say, wow, I understand it and I get it. Now, if you understand this next part, you will know 99% more than most traders that are out there. Most traders are just buying and selling. They don't know when they're buying, when they're selling, what is actually happening. This is going to help to cement that 100% within your knowledge and within your brain. Okay, now these are all prerequisites to understand where we're going. My strategy is very advanced. It's simple in terms of how to follow it because I've made it a step-by-step setup, but these are all things you need to know to make you comfortable when utilizing and deploying this particular strategy. Okay, so if you guys are ready, I certainly am. Let's jump right into it. Let's get started. Let's go. Beautiful. Okay, so for this next part, guys, I want you just to put everything outside of your mind and just visualize with me everything I'm busy saying, every place I'm saying. Put yourself in that position and follow me on this one. I can promise you towards the end, this is all going to make sense. Right. All right. So we're going to be taking a trip together. This is a visualization. Now, we are living in Europe, anywhere in Europe. Pick a place, put your mind there, picture yourself living right there, anywhere in Europe. Now, we planned to take a trip to America. It's going to be a short trip. It's going to be 2 days long, but it's jam-packed. We planned a bunch of activities, a bunch of things we want to see, and a bunch of things we want to do when we go to the US. Now, we buy our plane tickets, we go to the airport, and before we depart, we go to the currency exchange desk. Now, most of you would have seen one of these. If you've been to an airport, you'll see that there's a counter with a big red screen and all these different currencies and numbers that are busy flashing right in front of you. And this is a currency exchange counter where you can take your current currency and buy another one. Now, you need to also know that in most countries it's illegal just to buy and sell currency on the street. You have to do it through an authorized vendor like a currency exchange service, right? So we don't care about this. We're super excited. We know we're going to America, but because we're going to America, we need some United States dollars, right? In case, we've got our Visa, we've got our MasterCard, but in case, there's something we need to pay for, there's an emergency or whatever the case may be, we need to have a little bit of cash on our hand, right? Some pocket money just to, keep our pockets warm and give us a little bit of safety and security. So as of the 13th of July, we go to the counter and the lady says €1 buys 1.1803 United States dollars. So we're not too familiar with currency exchange, but the thing we observe is that €1 is buying you 1.18 United States dollars. So €1 is buying more than $1. So €1, the euro is currently stronger than the dollar. We can see that just in the numbers. So we observe that, and that's cool. Again, we don't care. We're going to America. We're super excited. She then reads out a bunch of different numbers to us. €1 buys 1.1803. That's the conversion ratio. And then $1 buys 0.8472, right? So one United States dollar buys 84 cents in euros, right? So we can see that €1 is worth more than $1. All right, but again, we're not too concerned. All we want to do is hand this lady our cash, show her our passport that we are traveling to America and that we do qualify to obviously obtain some United States dollars. So we hand our €1,000 over to her. She takes our money and she gives us back $1,180.30. Now we're pretty happy. How we got that, we're not too worried about that. We take that money, we put it in our pockets. Now, it's important at this stage to note that most currency exchanges will have what's called a fee, a commission. And in most cases, this is a spread, a difference between the buying and the selling price of a particular currency. Because remember, we're selling them our euros, so they will give us a price to buy the euros, and then they will give us a price to buy the dollars. So in this transaction, we're selling euros and we're buying United States dollars. You with me? Beautiful. Right. Now we're super excited. So we head on to our plane. We jump on the plane. We have our money, our $1,180.30 in our pockets. We fly over to America. We have an absolutely great time. Over the next 2 days, it's a short trip. We go and we see a ton of things. We have a ton of fun, and we don't spend any of the $1,180.30. It stays in our pockets because it was for emergencies only. Most places accepted our cards in any event. So we had a really great time, and our flight is scheduled to come back only 2 days later, which is the 15th of June. So the 15th of June comes, it's ready. We go over to the airport, but we also remember over the course of our stay, we read on our phones, we were keeping up to date with friends and families, but there was a news article that popped up about Brexit and Britain exiting the European Union, and it's negative for the euro, it's negative for the pound, and that there was, financial trouble looming, and people were speculating against that. But again, we're not too worried about that. But in summary, the article saying the euro would suffer from this Brexit, British European exit issue that's busy happening. Again, we're not too concerned. Put our phone back in our pockets, and we are now at the airport and we fly back home. So the 15th of June, we fly back to Europe. We get back to the airport, and just as we're about to leave, we remembered we still got these dollars in our pockets. Now, again, it's illegal in most countries to keep foreign exchange. You've got a certain time in order to convert it back into your local currency. So instead of dealing with all that hassle, as we get out of the airport, remember we've got to get to this currency exchange counter and we've got to get our euros back. So we go back to the currency exchange counter. We see the same lady that helped us originally, and we go up to her. We say, listen, man, we got this $1,180. You'd like to get some euros back? She remembers you. She smiles. You give her your passport. She checks you were legitimately in America, and she starts the process. She reads out again a bunch of numbers, and she says, today, sir, ma'am, €1 buys you 1.1601 United States dollars. Now, she's still talking at this point, and you're thinking back to yourself, all right, when I left, €1, right, was buying 1.18 United States dollars, okay? Now that I've come back, €1 is buying 1.16 United States dollars. What has happened here? Has the dollar got stronger? Has the euro got weaker? Has the euro got stronger? Or has the dollar got weaker? You're wondering to yourself, what has happened here? So originally we saw that €1 is buying 1.18 United States dollars. It's only buying 1.16 United States dollars now. So comment down below. I want to hear from you guys. What do you think happened in this 2-day period that we were away? Now, bear in mind, we did get that news that there was some Brexit and there was some worries, but did that weaken the euro or did that strengthen the euro? I'd love to hear and see your comments down below. What do you think? Now, we look back at the lady, she's still busy talking, and we come up with the conclusion ourselves. The correct answer is that the euro got weaker over that particular period. Okay, so we can see now that €1, now that we're back in Europe, buys less dollars than it did before, because €1 is buying 1.18, now it's buying 1.16. So we come to this conclusion in our heads, and we hand over our $1,180.30 back to the lady. She does a little calculation, she prints a little slip, and you hear the money machine going, and then she hands you back €1,031.87. Now you're sitting here going, okay, I started with €1,000, I bought some dollars, I sold those dollars to buy now euros again, and I've somehow landed up with a profit. What's happening here? And you're busy wondering this to yourself. Ultimately, we just made €31.87. How did that happen? What just happened here? We know the euro got weaker, but how did we profit from that exchange? Let me explain. So this is where it gets crazy, this is where it gets fun, and this is where I'm hoping you have a revelation. So in this case, before we left Europe, we sold the euros to buy the dollar, meaning we sold euro USD. By selling this pair, it meant we sold the euro and we bought the dollar. We held onto that dollar for 2 days. And whilst we were holding onto that dollar, the euro fell in value. There was negative news. So when we came back after 2 days, we closed our position. By closing, it means that we're buying back the thing that we once sold. Now, because the euro became cheaper, became less in value, the same dollars that we're holding buys back more euros than what we had to start with. So those €31 of profit is because the euro got cheaper and the dollars that we were holding in the time that it fell was able to acquire more than what we originally started with. And this resulted in a €31 profit. Now, the crazy thing is, this is how an actual Forex transaction happens. This is a real transaction that we did in 2018. The beauty of this particular transaction and the beauty of Forex is we didn't have to get on a plane. We didn't have to fly across the world. We didn't have to hold real currency in our pockets in order to do this. With technology and brokers and leverage, we're able to do this from behind a PC to make a lot more profit than just €31. Let me show you how. Let me show you what that looks like from a charts perspective. Okay, let's get into it. Okay, so this is a real chart from 2018. This is the chart from 2018 of the trade that we're busy talking about. So over here we can see that we're dealing with the pair Euro USD. Okay, now remember, the euro is the base currency, the dollar is the quote currency, which means €1 equals how much in dollars. As of the 13th of June, we can read here that €1 equals 1.18006. 1.18006. Now, at that point in time, we left Europe, we sold euros to buy the dollar. So we're holding the dollars now, right? Then when that news came out, the news came out that there was Brexit, whatever the case may be, the exchange rate for Euro USD fell. Euro fell in value, but remember, we're holding dollars at that original rate that we originally bought it. Then on the 15th of June, we closed our position at 1.16016, meaning those dollars that we were originally holding, we then bought back the euros that have substantially decreased in value. And because it's cheaper now, we're buying back more euros than what we originally had when we sold them. And that is a Forex transaction right there as it happens. Okay, now let's just go into that in a little bit more detail and look at what's happened. Now that is an actual Forex transaction in terms of how it happens. So when we're buying and selling currency, it's important to understand what it is that we are busy doing. So as an example, should we have anticipated that the euro will gain in strength, we would have then bought Euro USD, which means we have dollars, we're buying the euro and we're holding on the euro. So that as Euro USD increases, right, 1 euro is buying more and more and more dollars, meaning the dollar is becoming cheaper. At the end of that transaction, we would close that trade, buying back the dollars that we originally sold for cheaper and thus making a profit. So when we look at a currency combination that is falling, right, when we sell that currency combination, we're selling the base to hold the quote. When we are buying a currency combination, we are selling the quote to hold the base. Okay, so as an example, if we have a look at something like USD ZAR, right? United States dollar, South African rand. Okay, so 1 USD is equal to 14 Rand 40, let's just say, at any particular point in time. If it is expected for the South African rand to decrease in value, what would we be doing? Would we buy or sell USD ZAR? Question, and you can leave it in the comments. If the South African rand is expected to decrease in value, there's negative fundamentals, there's negative news, there's whatever the case may be, the expectation is that it is expected as ZAR to lose momentum or lose strength. Are we going to buy or sell USD ZAR? The correct answer would be that we would buy USD ZAR. We would sell the South African rand to buy the dollar, the base currency. We would hold the dollar. And as the South African rand gets weaker and weaker, which would result in the chart going up, we would then make a profit as that chart goes up. When the South African rand has decreased in value, we would close our position by buying back the South African rand, but because it's cheaper now, we derive and make a profit. Okay, so I hope this is making sense to you, and this is most important to just understand the simplicity of a transaction. It's not just one transaction, it's buying and selling initially, and then ultimately closing your position in buying and selling once more, in terms of taking that profit out of that particular market. Now, that's what a Forex transaction is. It is just that simple. When we expect weakness on one particular currency, you don't want to hold the currency that is getting weaker. You want to hold the currency that is either stable or getting stronger, of the two. So whenever a currency is getting weaker, you want to hold the stronger currency. You never want to be holding the potential currency that's getting weaker. And this is why countries hedge, right? So when they're going through times of turmoil, let's say South Africa or Botswana or whatever the case may be, they may be going through elections or riots or whatever the case may be, they would buy the American dollar, right, while their currency is getting weaker, so that when their currency is stabilized or finished getting weaker, they'll close their position in dollars, buy back their own currency, but because their currency is cheaper, they're buying their currency back for a profit. Now, this is something that governments, that all massive institutions do, and this is how we partake in the Forex and financial markets. Now, this can happen over different time frames. It can happen in short term, medium term, or long term from an investment perspective, but this should have helped you to understand an actual transaction in terms of how a Forex transaction sort of plays out from the point of buying to the point of closing out a position. I trust this is making a bit of sense to you guys. In terms of the chart, if the chart is overwhelming, remember we're going to cover that in great detail. What are candlesticks? What is the x-axis, y-axis, pips, time, all of these things we're going to be covering in great detail. But I'm hoping if you're a beginner and you're just starting to understand this hopefully makes sense. There's a lot of existing traders that have been trading for 2-3 years that I show them this concept and it's like a oh wow moment. Now it's making sense, and I'm hoping you're having one of those oh wow moments. But again, this comes with practice. We'll be spending a lot of time in the markets, a lot of time on charts, analyzing some of the fundamentals as they come through, taking positions. So this is just to get you ready for those bigger moves, and the more time we spend in it, as with everything, practice makes perfect. So hoping you enjoyed this. Okay, guys, we've just finished up that visualization. I'm hoping it's starting to make sense. Remember, we're going to be spending a ton of time together outside of the education. We're going to be live in the markets every Wednesday together. So remember, if you're stressing, don't stress. I'm here. Everything is going to be okay. Now, the next topic, brokers, is a controversial one. People aren't going to like what I have to say about this, but most importantly, it's there for you guys. It's there for your protection, right? To understand the ins and outs, it is super important. Knowledge is power. And when you arm yourself with this kind of information, it's very hard to be deceived because you are generally 5 steps ahead of where they think you're at. And this is obviously going to protect you. There's a lot of great brokers in SA, but there's also a lot of brokers who are not. This will apply to brokers around the world, and understanding a little bit about their models, how it is that they make money, where there are conflicts and where there are not. Right now, I don't do what I do and educate for the reason of hurting anybody's businesses, but ultimately, you know, the public out there need to understand and safeguard themselves. We have great regulatory bodies within Southern Africa. The old FSB, which is now called the FSCA, is there to regulate and make sure that as part of the public, you guys are protected. So we're going to be going through some of these things. Some of them may be new to you, some of them may not be new to you, but I'm hoping at the end of this, as with everything, you guys have some sort of revelation in terms of this information. So let's jump into it. It is going to be a little bit controversial. I'm loving this track in the background. Anyway, let's jump into it. Let's have a look at what's busy going on. Okay, so let's jump right into it. So for everybody to understand, obviously, what is a broker? There are brokers in many different financial fields, right? But in our particular context of the FX trading side, these are firms that provide us with access to platforms and access to obviously trade instruments, right? These will be CFDs. These are contracts for difference. These will also be derivatives, right? Commodities and cryptocurrency. So brokers' jobs are in order to provide us with a platform, provide us with a facility to be able to deposit and withdraw, and give us access to these markets with regards to the actual data feeds themselves. Now, Forex broker, Forex trading broker, currency trading broker, these are all under the general term of broker. Now, there are different brokers for different things. There's life insurance brokers, there's all kinds of brokers, but for our particular application, we're referring to brokers as a very general term for our particular Forex trading brokers, right? They generally open up access to the markets to us. Now, individuals, as we did in Let's Take a Trip, cannot just go onto the street and just start buying currency and selling currency, right? That's obviously illegal. You need to obviously have a route to market, you need to be regulated, and so brokers assist us with getting to that particular market. There's nothing stopping you from jumping on a plane and buying your limit in terms of currency. Most countries around the world have got about a $10,000 carry capacity, so you can carry $10,000 on your particular person. But in honesty, without leverage and without all these other things, $10,000 is not a lot of money to make money with a one-to-one leverage, right? So we're going to be talking about leverage and all these other amazing things. So that's why we use brokers as we use them in other places, in residential and buying and selling of homes, insurance policies, so and so forth. So what is a broker? A person who buys and sells goods or assets for or on the behalf of others. Now, because we cannot access the markets directly, we utilize brokers who have an FSP license, right? Their platform is licensed, they're licensed within a local jurisdiction, and we'll talk about that FSP license as well. So essentially they can act as our agents, and they are regulated. The purpose of the license is to have some sort of oversight and some sort of regulation, but we will talk about that towards the end. In the same way, we use a real estate agent to purchase a property. So again, as I said, there's nothing stopping you from flying to America, buy $10,000 here in Southern Africa, fly there for a holiday. The problem is the likelihood is that you're going to be stuck with those dollars for 2, 3, 4 days a week minimum. Remember, it's a 24-hour travel period, and you can't speculate whether the currency is going to go down or up within that particular point in time. So it's just inefficient. We utilize this route the same way we would utilize a real estate agent to purchase a property. You could go up to a person and say, hey, I want your house, and negotiate directly. But ultimately, you don't have the knowledge to go and look for the rates and taxes, go look for all the electrical certificates, or go to look at any of the deficits or issues with the property that a real estate agent would be trained to obviously look for and provide you that information, ultimately protecting you as the buyer. So in a real estate transaction, we would go to real estate agents, they would go and they would find us a home, and they would act as the middleman. They would sell us the home for a commission, right? And in this particular way, there is no bias, there is no conflict of interest. They're providing us with a service, a product that we've asked for, and are merely charging a commission for that product or that service. So pretty straightforward, right? Now, when it comes to brokers, we have essentially two models that most brokers use within their systems, right? Two different ways of how they conduct their businesses. There is a third way, which is considered a amalgamation of the two, but I really want to talk about this, guys, because this ultimately, choosing where to align yourself can honestly mean you can have the best strategy in the world. You can have the right trading plan, you can have the right trading partner, the right mentorship program, but if you are in the wrong environment, you are stacking the cards against your favor. Now, we're going to be talking about this in a pure way, right? There are other external factors that could make it worse, but we're just going to talk about this, right? Now, in the world, we have what's called two models from a brokerage perspective, and you can go Google this. This information is free for those who can find it. Just Google A book versus B book brokers, and you'll find the information out there. I'm going to simplify it and I'm going to expand this for you, probably make it a little bit more technical, but I'm going to explain it to you in real world terms. So here's you. This is Bob, right? Or Jane, right? You've got a laptop or you've got a cell phone, and this is where you access your trading terminal, right? In the middle, you've got the broker, and on the other end, you've got the markets, which we call liquidity, and these are big banks, right? So it's ultimately a big bank offering liquidity over to the broker, who then offers that over onto you. So in this model, you place an order, right? You want to buy Euro USD, you want to buy a currency, whatever the case may be. The broker collects that order, right? Charges a very small fee on that, usually a tiny fee, and then he sends that order to the markets. Now, once that order is closed, or you close that trade, the markets will send that order, profit or loss, back to the broker. He would collect either his first fee would have been inclusive of the second, but generally it's a split in terms of a buying and a selling fee, the spread that we refer to, and then the order comes back to you. Now, this is pretty simple, right? We create a trade, goes to the broker, goes to the market, profit or loss comes back to us. Pretty simple, no issues there. right? This is a perfect world scenario, and this is what's called an A book environment. Now, very, very few brokers have an environment of this nature, right? Now, if you look at the definition of a broker is supposed to be a middleman. A broker is supposed to be there without conflict, to neither profit or gain or loss from your profit, gains, or loss, right? They're merely supposed to charge for a service which is providing you with access to these commodities and assets. Whether you make a win, whether you make a loss, shouldn't make a difference, right? They're merely providing you with a service. If you buy a bad home, the agent still charges a commission. That's the home you picked, that's the home you wanted, you paid for it. Agent's got his commission, so there shouldn't be a conflict or reason why they need to sell you a bad home, so on and so forth, right? In my opinion, and I'm just going to state that is my opinion, all right? Now, if we have a look at the next model, which is unfortunately a lot more widely used, specifically in third world countries or developing countries, this is what this model looks like. Okay, same situation whereby here is you've got your trading terminal. The difference here is that when you buy your USD, right, because brokers know and understand that most people don't have the right trading and education, the statistics I'm underquoting, but most people are going to lose more than 90% of their account in the first 90 days. Regardless. So they can win a trade, whatever the case may be, but generally speaking, most people who enter the FX markets are going to lose more than 90% of their money in the first 90 days. So they understand that, right? And ultimately what has happened here is a little bit of, in my opinion, and again, I'm saying my opinion because it is only my opinion, is a bit of greed in the sense that instead of sending your order to the market, which they've got to pay for, right? They've got to pay that spread that they charge you is partly cost that it costs them to execute that trade to market, which they then mark up and they charge you. Instead of sending it to market, they keep it in-house. And because they know that most traders are bad at what they do, they then utilize the spread that they're charging you, right, for a trade. They're utilizing that fee and they're sending the opposite order to the markets. So when you say buy your USD, they're selling your USD. So not only are they hedging and internalizing your entire trade of your account, but ultimately they're profiting off of your loss directly with further profits off your trading going in the wrong direction. Right, and this is called essentially a B book. Now let's read this, right? In this model, brokers hedge a trader's position within their fund, understanding that 90% of traders lose 90% of their money in the first 90 days. Now again, these are just round 90s. It's actually a lot more than that. Avoiding extra fees to place trades on the market. Because the vast majority of traders do not have the skill and education to trade, they are wrong majority of the time. So brokers with a dealing desk take the opposite side of your order and execute to the market. Summarized, when you win, they lose, and when you lose, they win. Okay, now this is a massively controversial thing, and I know by speaking about this, a lot of people are going to get upset. A lot of brokers are probably going to get upset too. Quite honestly, I don't care. This is stuff that people need to know. Now, ultimately, right, if this was the case, and how they manage their money, right, had nothing to do with us, and it doesn't have anything to do with us, there shouldn't be an issue here, right? If they're seeing a more profitable way of offering a service and they're seeing that those fees and that those trades aren't going to profit anyway, and they choose to hedge it internal, no issues. The problem comes in here where brokers, specifically in this model, offer signals, right, as the brokerage, say, hey, we'll give you trades to help you profit, which are not profitable signals. You end up losing money anyway. Or B, they run internal algorithms to make it harder for you to make money. Again, I'm saying these things, people aren't going to like it, but this is the truth, right? Internal algorithms to make sure that you end up losing money. And this can be manipulation of spread, this can be manipulation of your leverage at different times in the day or the evening. But ultimately, when these other measures are deployed, for me, this is hugely unethical. The third way that this is now run is ultimately, and again, I'm speaking about these things and people are not going to like this, but ultimately what happens here is that these brokers will look for traders. They'll look for guys who have big followings, and they'll say, okay, listen, we'll give you an agreement, and everybody you bring to us, we will share their profits and losses, right? This is where it gets really crazy, guys. So a trader will come in, they'll say, listen, we'll give you an agreement, and whatever your people lose, let's say they deposit 100,000 Rand and they lose 90,000, we'll take 60 and we'll give you back 40% of that money that they give back these traders. And so this has resulted in a lot of traders selling their souls, right? Having these IB agreements that they're essentially bringing a lot of people into, no risk management. So they want you to trade big volumes. They want you to trade all the time. They want you to do all these things. And ultimately, once they've crossed that line, they've sold their soul. They have no longer a responsibility to make sure that you profit or make sure that you learn. Because if you profit or learn and you actually get better, you get outside of that 90% who fail, then they ultimately don't make money. And so this is something within the industry that I'm personally against. Again, there's unfortunately a lot of people that are busy doing this. So when you're given a link and said, hey, go and join there, ask yourself, what is the reason and what is the motive? Now, full disclosure, so that you know, I do have affiliations from a broker perspective. I only deal with brokers, that have international liquidity, meaning that they are sending their clients trades outside of Southern Africa to be executed against real liquidity. So that's one of the first things that I check. Do they have an A book? Yes or no? If the broker doesn't have an A book, I have no dealings with them. B, I do have an IB agreement, right? Meaning that when you come and trade with me in these environments, that I earn a very small markup of the spread. So if you're paying $1 per trade, I might make 20 cents of that trade as an example. So that helps to keep something like this channel going. It helps to do what I do at no cost to you, because that is a cost, a fee, a spread you would pay in any event, whether it's to the broker or it's shared. This helps to keep these kinds of programs running. Now, again, there may be a lot of people who are not happy to hear this, but unfortunately, that is the reality. I only deal with people that I have proven to be trustworthy and brokers that have built a track record of looking after their clients and that have real liquidity agreements outside of this particular country. But this is a very big problem that we're currently facing. So when you're looking for a broker, you have the opportunity to ask these questions. Now, a lot of brokers will say, but we have a license. The thing is, that license also has certain limitations, categories within that license. Now, I will be making a separate video a little bit later, not within the series, about the FSCA's conditions for licenses. What do these licenses mean? What do these subcategories mean? But ultimately, a lot of brokers are registering outside of the country. So they're getting registration outside of the country. So they'll be registered in some sort of tax haven. And that FSP is not recognized here in Southern Africa. You want to make sure that your broker, at least that you're trading with within your particular country, is registered and recognized in the country that you're trading, because then you have recourse. If something goes wrong or your money gets taken, whatever the case may be, there is some sort of recourse in order to manage that and potentially get your money back. When a broker or financial entity is registered outside of the country and is not regulated here, you actually have zero recourse. So that is a very, very important thing. Now, again, if you want to obviously be with a broker, that someone that I trust and someone that I've seen look after many of my clients, you're welcome to obviously follow that controversial link down below. Just know that that link is something that I profit from, but not in a way that is at your demise. It's at a spread value, and it's at a value that keeps this channel running and keeps me being able to do all the amazing things that I get to obviously do with you. And then you're at least within a trusted environment. If you need help, I'm able to help on your behalf with that particular broker. This will change from time to time, and I will be announcing some really powerful information and some really exciting news in the days to come, because it's always been our dream to, in order to fix a situation, Much like with this educational series, we're looking to empower people that they cannot be taken advantage of. We know that one day it has been our dream to obviously own a system where we could be running a full A-book broker, regulated here in Southern Africa, STP services, straight through processing, that we can give our clients absolute best level in terms of a trading experience, an unpolluted, pure, simplistic trading experience. And that's something we wish to announce very, very soon. So obviously stay tuned for that. But like I said, if you're looking for a trusted broker, somebody that I trust, you're welcome to hit the link down below. The link will be there. You can sign up, you can create a demo, have a look at what's busy going on, and then ultimately create a live account as you wish. So let's move on and let's have a look at these differences and what this all means, and what else a broker offers, and what are the things that you obviously need to pay attention to. So let's have a look here. Okay, so outside of the actual internal models that different brokers obviously use, there's obviously different things that a broker offers, and these are the things that are probably going to be most important to you in order to understand what are their services and how is this a benefit to you. So again, as I said, I only deal with A-book entities that have international liquidity, that are regulated. So again, that link will be down below. But we're going to cover some of the most important aspects of a brokerage, which will help going to pick which broker you want to use. If you want to use mine and obviously be with the broker that I'm busy using, 100%, but this will also help you in the future and just to understand a little bit more about what it is that they do. So brokers use banks who act as liquidity providers. So again, when we talk about A-book liquidity, we're talking about a broker who has access to real markets, real instruments, real liquidity out there, which is what they can then offer onto us. So liquidity providers offer leverage, right? And leverage is a very, very powerful tool that allows us. In our visualization, we only made 31 euro, where with leverage, that could have been closer to 300 or 3,000 euro with effective leverage added on to that. So the meaning of leverage is to the exertion of force by means of a lever. So it's doing a small amount of work to achieve a great outcome. So using a little bit of money to have a great outcome. Now, it's also at this point important to state that leveraged products are very, very risky things, right? Most of the FX markets have leverage, CFDs, derivatives, all of these things have leverage applied to them, and leverage is kind of like a double-edged sword. If used right, you can obviously make great gains from it, but used wrong, it can also be more effective at wiping out your account. And this is why, generally speaking, leverage, people start off quite high, and as your account gets bigger, you tend to want to reduce your leverage that your account can hold. Many people do the opposite. They take more and more leverage. I've just found for my personal trading, and the larger the fund gets, I reduce leverage to make sure my account's not as exposed. You limit profits, but you also limit losses. So that is that double-edged sword that I'm talking about. So that lever allows us to make bigger trades using less capital to do so. That's why on our visual journey to Europe, or from Europe to the USA, we only made about 31 euros profit, even though we risked the full 1,000 euros on that particular trade. We made substantially more on our side due to leverage applications there. Through leverage, we risk a small amount to lose or gain a bigger amount. Okay, so this is a small table in terms of how leverage works, and I'll just jump out of the picture there so you guys can see the full table. So in this particular case, we have one-to-one leverage, and this would mean that $100 in your account has the purchase power of $100 on the market, right? So 1% gain in profit is $1. Straightforward, your return on investment is $1. So example, if you had to invest $100 into one position in the market and that whole market moved 1%, you would then profit $1 off of that move. Okay, in 10-to-1 leverage, right, it means that your $100 account can exert $1,000 worth of purchasing power within the market. So your $100 account, if you had to take a position with your full $100, it would have the effect on the market of 1,000, and 1% move in the market would result in 10% gain, which is $10 on your account. 50 to 1, we're going to skip, it's not as common. 100 to 1 is more common and kind of where I recommend people to be. 100 to 1, 200 to 1, where $100 of capital in your account, if a trade is opened up for the full $100, you would have $10,000 worth of leverage on your account. So if the markets move by 1%, right, you would have profited $100. That's 100% return on investment. Now people go all the way up to 1,000. I've seen places that offer 2,000 to 1, so on and so forth. But remember, equal and opposites, right? If you've got 100 to 1 leverage and the market moves, let's say you open up a position for that full $100, which you shouldn't, and we'll cover that in our risk management profile. If the market moves against you by 1%, it means that your $100 is wiped out. Okay, so this is where I generally recommend the bigger your account gets, reduce that leverage. In the beginning, it's a great tool, right? Your $100 got some purchasing power, you can make some trades, you can grow your account, but you need to be a lot more attentive to the details, a lot more attentive to the risk management, your entry of trades, so on and so forth. When it gets bigger and you reduce your leverage, you can be a little bit more relaxed. And obviously you're taking a lot more trades, so you need that extra bandwidth to obviously concentrate on other things. So generally speaking, leverage is a great thing if used right. So again, like I said, 100 to 1, this is generally where I recommend people to sort of be, and I think that's kind of a safe zone. 100, 200 to 1, somewhere around about there. Anything above that's not needed. Anything below that is not needed in the early stages. That's generally where I recommend to be. But again, remember, please, leverage products in general are extremely risky. If you look at buying stocks as an example, you're buying that individual stock. So if you're buying Apple shares, you're buying one Apple share. If that stock goes from $100 to $101, you've made $1, right? Where if that was a leveraged product, right? Again, if you had 100 to 1 leverage, you bought a $100 stock with 100% leverage, it means that $1 move would result in $100 profit, as per the table we've just seen over here. So again, can be an amazing tool, but extremely, extremely risky. There's high risk, high reward, but done wrong, you obviously blow your account and you lose money. So that's just an important thing to understand from a leverage perspective. Okay, now moving on to the next major item is definitely going to be spreads, right? Now, this is what a broker charges in an A-book model in order to make money, right? The difference between the buying and the selling price. So in our visualization, we explained that a broker earns their keep by charging a commission, which is called a spread. Some brokers can charge a commission and a spread. So they'll charge a lower spread, but then also have a commission in lot value. So they'll have a $1, $2, $10, $20 per lot commission. We'll talk about that. We'll talk about lots. We'll get more into that in a little bit more detail a bit later, right? But in essence, the spread is the difference between the buying and the selling of a particular currency pair. Now, if you've traded before, you should have seen this box. This is the where you essentially engage or jump into a trade. Now, there's some important information here that is really going to be valuable to you, and I actually use this box for a lot more than just understanding the spread. So at the first here, on the left-hand side, you're going to see a tick chart. Again, we're going to go into this in quite a bit of detail. The most important things I want you to observe here is that you can see here we have a blue and a green, a blue and a red line here. This is the buying and the selling price of this particular instrument. At this particular point, we're looking at Euro USD. So the buying and the selling price, you can see, was very close to each other at this point in time. And then where we are now, we see it widened up. Okay, this could be due to a news event, this could be due to a market overlap. But what you need to know is that is, if they're going to sell Euro USD to you, right, this is the price you're going to pay, 1.3662. If they're going to buy it from you, right, they're going to sell it to you, right, then they'll charge the 1.1372. The difference in these two prices is what you pay. The difference between bid and ask, buying and selling, right? In this particular case, we can see here that at the moment there's a very high spread. It should be much smaller, but this is because of news or some sort of event. So here we can see we would in essence end up paying let's see, 6 pips, just over 6 pips, 6.4 pips here in terms of spread. Now I will explain fully what a pip is. A pip means a percentage in points. We're going to get into great detail about that a little bit later, but this is where you would monitor the spread of a particular asset or commodity. So it's also important when choosing a broker to understand what are the spreads, and not necessarily what are the spreads on just the generic stuff, but what are the spreads of the stuff you are going to most likely end up trading. That is just as important. So this is where we would monitor that. And again, a broker earns their keep by charging a spread if they're operating in an A book entity, right? If it's B book, it doesn't matter. They're charging you that fee, but they're taking your money anyways, right? I won't name names. I'm not here to hurt anybody's business, but I am here to empower you to make the right decisions. In most cases, I believe it is legal for you to even ask your broker, hey, are you running an A book or B book? Who is your liquidity provider? And you can ask those questions. I am under the understanding every time I've asked, I've received an answer, and I assume you could ask the same things too. All right. So spread is quite important, and like I said, that is how they earn their keep. But again, we're going to obviously understand pips and how to calculate them. We're going to do a little bit of quick math a little bit later, and I'll show you obviously how to fully understand that spread. Is it expensive? What does that even mean? What does a pip mean in dollars, in rands? What does that mean in real life, in real terms to you? Don't worry, I'm going to unpack that in obviously great detail. So I've spoken a lot of things here in this particular video. I know a lot of people may not like this. This is the reality. That's what it is about. I'm not here to sugarcoat. My promise to you in this series was it would be undiluted, absolute truth of the things I've learned and the truths that I found within this particular market. There's a lot of people doing good, but there are some doing bad. Your goal is to avoid getting caught out. Trading is as hard as it is. You want to limit the amount of factors that are going to make it even more difficult for you. So if you can get through these steps and make sure you are in a safe environment, when we get to end, when it comes to trading strategy, you're going to have an absolute blast. Okay. Moving on, we're going to end up talking about the different types of trading platforms. So without further ado, let's jump straight in. Okay, brilliant, guys. Up next, we're going to be talking about trading platforms, right? Plural, because there are many out there. There are many different types. There's some that look great. There's some that work great. But ultimately, the industry standard right now is MetaTrader. MetaTrader offers a MetaTrader 4 and a MetaTrader 5, very, very similar to each other. MetaTrader 4, for a large extent, is no longer being supported from an update perspective. Whilst MetaTrader 5 doesn't look much different, there are some smaller features. To the untrained eye, it looks exactly the same, but there are some smaller features that make your life a little bit more easier. And so for the purpose of this, and because it's such a widely used platform, we're going to mostly focus our training around MetaTrader 5. Now, we are going to go through how to download the platform, how to set it up. I will be releasing a separate video, which is a MetaTrader 5 walkthrough, which means every button on MetaTrader, every navigational, to set up your charts, set up your templates, to open and close different features and different views of different things. I'll be going through every single button as a separate supplementary video. So just look out for that. I'll try and link that description down below. Just a quick one, based on the previous video on brokers, and I hope you guys have watched it. How did you find that video? What was the most controversial thing that you heard there? Was there any realization? Are you with the right broker? Let me know what it is you guys think down below. And as always, hit that like and subscribe button. It does a ton to build up this channel, which allows me to build and obviously spend ultimately more time with every single one of you. So without further ado, let's jump right into it. Let's get into the different types of trading platforms on MetaTrader. Okay, brilliant. So obviously we're going to be speaking about MetaTrader 5. Now, I will link a description down below if you want to jump in and you want to get downloaded. You may want to start a whole new download. You may want to start afresh. And so I will link the description down below. You can have MetaTrader 4 or you can have MetaTrader 5. I'll provide both links, but ultimately MetaTrader 5 is where you want to be. There's a little bit more updates, a little bit more support. Again, provided your broker supports it, the broker link that I'm providing down below does. This may change from time to time, and I do have, like I alluded to in the previous video, something very, very exciting. We will be announcing very, very shortly about what we feel is going to be the future of trading. So very exciting news. We will obviously be speaking about a little bit later on. But in terms of the context of this particular setup, right, MetaTrader 5 is super easy to get set up. In essence, get the program downloaded, and as you download and obviously open up the program, it's going to ask you to open an account, right? Generally speaking, if you're brand new to this, you very well may want to run on a demo account, and this you can set up very, very easy, right? Select the broker name, select real or demo, provide a little bit of your information, and you can proceed and hit next. This will in most cases send you an email to verify these are your login credentials. These login credentials you can also use to log in on your cell phone if you download the MetaTrader 4 or MetaTrader 5 app on your phone through the Play Store or the App Store, iOS App Store. All right. But generally, once you have downloaded or once you are set up, you are good to go. You can then obviously go through to my walkthrough video and go through all the information and details in that particular walkthrough for any information you may need. If you need any help on this particular subject, whether it's being set up, whether it's issues, whatever it may be, you are welcome to send an email to support@dvdm.online, and my team will get back to you. It can be anything. You can be struggling to log in, you can, whatever it may be, it does not matter. It's an absolutely free service that myself and the team, as this particular channel and my brand, we will be supporting you with for absolutely free. So any issues, anything you need help with, you can email that support@dvdm.online and we will help you out with. Now, as I said, once you've gone ahead and created an account, you will be emailed some sort of password, right? That password you need to write down and save, because this we're going to be using when we log in to our phones. So you can go ahead and download the application directly off of the Play Store. So you can go ahead and find the application, put in your broker, whomever it may end up being, and then you will select and place the same information that you received from your original registration on the actual desktop application. If you only have a cell phone and you only are able to utilize your cell phone, that's perfectly fine. It's a good place to get started. We will obviously evolve, and hopefully the goal is to get you onto a desktop solution. But this is just to get you set up. We will obviously have the video that covers the full range of features within MetaTrader 5 desktop, the full navigational suite, and this should obviously get you to the point where you're comfortable with navigating. There's nothing you can break, there's nothing you can't undo, so be comfortable. This is ultimately going to be your office, so the more time you can spend within the software, the more time you can spend playing around, the better for you. And again, as I've said, and I just want to affirm there, if you have any problems, you need any help, or you'd like to see any future content pointing out a specific issue, addressing a specific issue, simply email support@dvdm.online. And as always, leave a comment down below what you found interesting, if anything, and I'm going to be seeing you guys in the next one. The next one is charting, so we'll be jumping straight into charting. This is going to start to get you comfortable with the platform, with the chart, being able to read and interpret those candlesticks and price movements as if it were English, right? I want to get you to the point where you can read price, where you can understand what it's doing, what it's done, and what it's likely to do. So I'm going to get you to a point where you can read price almost like a second language, just like English. So this has been a long one. It's been a controversial one. As always, make sure you smash that like and subscribe button. I will see you in the next one, and it is charting. I'm ready to go if you are. So I'll see you guys shortly.